Wesley just retired at 55. $800,000 sitting in his 401k. His advisor told him he couldn't touch a penny until 59 and a half. The advisor was wrong. Wrong by 4.5 years. Wrong by about $3,000 in unnecessary penalties. Wesley walked out of that meeting. He spent a weekend reading IRS rules. By Monday, he had a plan. That plan turned the 401k lockout into $150,000 of tax-free retirement money. Zero federal tax owed. Legal. Documented. Written into the tax code in plain English. Here's exactly how he did it. Wesley's situation isn't unusual. He spent 30 years maxing out his 401k. By 55, he had nearly $1 million. But he believed the line every advisor repeats. You can't touch retirement money before 59 and a half. If you do, you pay a 10% penalty plus full income tax. End of story. Here's what nobody explains. The IRS already wrote the workaround. It's called a Roth conversion ladder. Done right, it converts $30,000 a year from your 401k into a tax-free Roth IRA. Zero federal tax for 5 straight years. Before I walk you through the year-by-year math, you need to understand one number from the 2026 tax code. Without it, the ladder doesn't work. With it, the IRS basically hands you tax-free retirement money for free. By the end of this video, you'll know exactly how Wesley did this. You'll see the 5-year sequence that makes it automatic, and you'll know which one piece of paperwork most DIY investors get wrong. Quick note, I'm not a financial advisor. This isn't personalized advice. It's what the tax code says and what the math shows. Always do your own homework before making big moves with retirement accounts. Here's the thesis. Most early retirement advice teaches you to fear the 401k lockup. The Roth conversion ladder flips it. You don't fight the system. You use a number the IRS publishes every year. That number turns pre-tax money into tax-free money, legally, at zero federal cost. That number is the standard deduction. In 2026, for a married couple, it's $32,200. Any conversion under that figure pays zero federal income tax. Not low tax, zero. Phase 1. The free conversion room nobody talks about. Here's the rule almost every retirement video skips. When you do a Roth conversion, the converted amount counts as ordinary income that year. Convert $30,000. The IRS treats it like a $30,000 paycheck. But there's a key catch. The standard deduction subtracts directly from your taxable income. It applies before any tax bracket touches your money. It's the IRS giving you a no questions asked discount on the first dollars of income. In 2026, the standard deduction for a married couple filing jointly is $32,200. For a single filer, $16,100. So picture Wesley and his wife. They're retired. They have no other earned income. They convert $30,000 to a Roth IRA. Here's their tax return. Gross income from conversion, $30,000. Minus standard deduction, $32,200. Taxable income, zero. Federal tax owed, zero. This isn't a loophole. This isn't an aggressive interpretation. The IRS does the subtraction itself. The standard deduction wipes out the conversion income, and the math ends right there. And here's the part most advisors forget. The standard deduction adjusts upward every year for inflation. In 2025, it was $30,000 for joint filers. In 2026, it's $32,200. By 2030, it'll likely be near $36,000. The free conversion room keeps growing while you sit there. Now here's where it gets interesting. Even past the standard deduction, the next $24,800 gets taxed at just 10%. That's the lowest federal bracket. You can convert $57,000 total. Worst case federal tax bill, $2,480. The effective rate on the conversion is about 4%. Try finding that anywhere else in the tax code. For Wesley's plan, sticking to the $30,000 sweet spot keeps it at exactly zero. 5 years of conversions, 5 years of zeros. But there's a date on the calendar that can shave nearly a whole year off the waiting period. Most online tutorials don't even mention it. It comes up in the next phase. Phase 2, the 5-year clock that confuses everyone. When you convert 401k money to a Roth IRA, you can't turn around and withdraw it. The IRS makes you wait 5 years. That part most people get. Here's where it gets specific. The 5-year clock starts on January 1st of the year you converted, not on the actual conversion date. Calendar year, not calendar date. Watch what that means. Wesley converts $30,000 on December 31st, 2026. The clock retroactively starts on January 1st, 2026. By January 1st, 2031, that $30,000 is fully accessible, penalty-free, tax-free, forever. That's 4 years and 1 day of actual waiting, not 5 years from the conversion date. The calendar year is what counts. Most people never figure that out. Each conversion gets its own independent clock. So Wesley converts in 2026, then 2027, then each year through 2030. He creates 5 separate ladder rungs. Each one unlocks 5 tax years later. Wesley actually smiled when his accountant walked him through this. 5 years felt like forever. 4 years and 1 day felt doable. Suddenly, retirement at 55 made sense again. Here's the part that trips people up. The 5-year rule applies only to the converted amount. Roth IRA contributions you made earlier in life are different. That money was already taxed once. You can pull those contributions at any age. No clock, no penalty. The 5-year clock is specifically for the converted dollars, and there's no limit on how much you can convert in a single year. The Roth IRA contribution cap of $7,500 applies only to fresh contributions. For conversions, you can move $30,000 or $100,000 or $1 million in a single year. The only cost is the tax bill, which we just established can be zero. So if there's no contribution limit and the federal tax can be zero, what stops people from doing this? 3 traps. We'll get there in a minute. Phase 3. Wesley's year-by-year ladder. Let me show you the actual 5-year sequence. This is the money system for this video. The 5-year Roth ladder timeline. Download the full 1-page PDF from the link in the description. Year 1, 2026, age 55. Wesley converts $30,000 from his 401k to a Roth IRA. Federal tax owed, 0. Available to withdraw January 2031. Year 2, 2027, age 56. Same conversion. $30,000 moves from 401k to Roth. Federal tax owed, 0. Available 2032. Year 3, Year 4, Year 5. Same pattern. Each year, $30,000 converts at 0 federal tax. Each year, a new 5-year clock starts. By the end of Year 5, 2030, age 59, Wesley has converted $150,000 total. 0 federal tax paid across all 5 years. And by January 1st of 2031, the first rung unlocks. Here's the part that works in your favor. By age 60, when the first rung unlocks, Wesley has also crossed 59.5, so he can pull directly from his 401k too. No penalty either way. But his Roth withdrawals are tax-free. His 401k withdrawals would still be taxed as ordinary income. So Wesley structures his 60s to pull from the Roth first. Tax-free retirement money for as long as the converted bucket lasts. And here's something most people miss. The money that grows inside the Roth after conversion grows tax-free forever. Take Wesley's $150,000. If it doubles over the next decade, that's $300,000 of tax-free retirement money. The IRS takes nothing on the growth, nothing on the withdrawal, nothing. For comparison, picture Wesley pulling from the 401k at 60. He'd have paid federal income tax on every dollar, conservatively 12 to 15% over a long retirement. The ladder converts that future tax bill into 0, paid in advance, at the cheapest possible rate. And the math scales down cleanly for single filers. The standard deduction for a single retiree in 2026 is $16,100. Convert $15,000 a year. Federal tax bill, still 0. 5 years builds a $75,000 tax-free bucket. The dollars are smaller, the mechanism is identical. The first time Wesley's wife saw the unlock confirmation email, she pulled up the account balance. Then she just sat with it. The original conversion plus a few years of growth. All accessible, all theirs, 0 owed to anyone. They'd done it on paper 100 times. Seeing it real was different. Phase 4. The bridge problem nobody warns you about. Here's the catch. While Wesley is doing his conversions, he still has to live. Year 1, Year 2, Year 3. He needs money for groceries, mortgage, health insurance. Where does it come from? This is where most people quit before they start. They hear 5-year wait and assume they need 5 years of expenses sitting in cash. They don't. Look, I have to be honest with you. The ladder doesn't work for everyone. If your entire net worth is locked inside a 401k, you don't have a bridge. You have a wall. The strategy assumes you've built up at least one other money source. But here's what the FIRE community figured out years ago. You only need bridge money for the first 5 years. Once year 6 hits, the ladder starts feeding you. The first conversion unlocks, then the second, then the third. After that, it's self-sustaining. So picture Wesley with $200,000 in a taxable brokerage account. That money is already taxed. He can access it at any age. He uses it for years 1 through 5. $40,000 a year, drawn down slowly. Year 6 and beyond, the ladder takes over. And here's the part that surprises people. The taxable brokerage doesn't disappear into a black hole. He's spending the principal, yes, but his Roth IRA is filling up at the same time. He's trading one pile of tax-paid money for another pile of tax-free money. Meanwhile, the conversions themselves cost him 0 federal tax. For someone without a brokerage account, the second best bridge is Roth IRA contributions you already made. Those can be withdrawn at any age, no penalty, no tax. The third option is part-time work or rental income. The fourth and least preferred is a 72T SEPP from the 401k. We'll cover that one in a minute. The point is, the bridge is solvable, but it has to be planned before you retire, not after. Phase 5. 3 traps that wreck the ladder. Trap 1. The Pro-Rata rule. Imagine Wesley had a traditional IRA in addition to his 401k. The IRS would average all his traditional IRA balances together. That average sets the tax on each conversion. Even after-tax money in the IRA would get hit proportionally. The fix is specific. Roll your 401k straight into a Roth IRA. Don't first roll it into a traditional IRA. The 401k is exempt from the pro-rata rule. A traditional IRA is not. This is the single most common mistake in DIY conversions. It costs people thousands every year. Trap 2. The Affordable Care Act subsidy cliff. Wesley is 55. He's not on Medicare yet. He gets health insurance through the ACA marketplace. His subsidy depends on his modified adjusted gross income. Conversion income counts toward that number. Push it too high and the subsidy starts shrinking. The fix is to keep total income in check. That means conversions plus dividends plus any other income. For most early retirees, a $30,000 conversion fits comfortably under the subsidy band. A $60,000 conversion in the same year may not. Trap 3. The IRMAA cliff. At age 65, Medicare Part B premiums adjust based on your income from 2 years prior. So if Wesley's income at 63 is too high, he pays a Medicare surcharge starting at 65. That surcharge can run hundreds of dollars a month for the rest of his life. The threshold for a married couple sits in the low 200,000s. That last one is the one that follows you longest. Medicare surcharges don't expire. But here's the thing about all three. None of them are individually fatal. All of them are predictable. And there's actually a quieter fourth trap nobody talks about. What if you convert into a year when you also have unexpected income? A consulting gig, an inheritance distribution, a spouse's part-time job. Your tidy zero tax conversion stacks on top of other income. The bracket math changes overnight. The lesson is the same in all four. Conversions interact with the rest of the tax code in ways a convert and forget plan doesn't account for. The latter is a multi-year coordination problem, not a single year's tax move. That's the trap layer. Now compare the latter against its two main competitors. Most retirees pick the wrong one. Phase 6. Why this beats Rule of 55 and 72T SEPP. Two other strategies let you access retirement money early. Both are real. Advisors recommend both. Neither is as good as the latter for most people. The Rule of 55. Leave your job in the calendar year you turn 55 or later. You can withdraw from that employer's 401k. No 10% penalty. But it only works for the 401k of the company you just left. If Wesley rolled previous 401k plans into one consolidated account, only the most recent qualifies. And he still pays full ordinary income tax on every dollar. No tax-free benefit. No flexibility on amount or timing. The 72T SEPP. Substantially equal periodic payments. The IRS lets you withdraw a fixed amount from any retirement account before 59 and a half. The catch is you must commit to a payment schedule. At least 5 years or until you turn 59 and a half, whichever is longer. The deeper catch is the word fixed. You can't adjust the amount once you start. If your expenses go up, you're stuck. If you stop early, the 10% penalty hits retroactively on every dollar already taken. It's a one-way door, and the door locks behind you. Compare both alternatives to the latter. You can change the conversion amount every year. You can pause if you have a high income year. You can convert into a tax-free vehicle that grows tax-free for life. And the bonus is structural. By the time year 5 hits, you're 60 anyway. The latter works with your retirement timeline, not against it. For someone retiring at 50, the latter is essential. For Wesley at 55, It's the strongest of three good options. The 72T is the least flexible. The rule of 55 is fine, but leaves money on the table by keeping it tax deferred. The latter converts your future tax bill into zero, paid in advance, while building tax-free growth for the rest of your life. One last objection people raise. What if the market crashes during the 5-year wait? Honest answer, it might. The S&P has had multiple 20% drawdowns in the last 25 years. But here's the thing about Roth conversions. The amount you converted is what gets taxed, not the amount it grows to. So if you convert $30,000 and the market drops 30%, the position is worth $21,000 on paper. The conversion was already done at $30,000 of taxable income, which in this case was zero. Then when the market recovers, all of that recovery happens tax-free inside the Roth. The crash can actually work in your favor. The math is quietly on your side. So the question isn't whether the math works. It works. The question is whether you'll set it up before retirement when the standard deduction is still your friend. Here are the 3 concrete action steps. Step 1. Before you retire or in your first year of retirement, calculate your annual conversion target. The formula is straightforward. Take your filing status standard deduction for the year, $16,100 single, $32,200 joint. Subtract any other taxable income you expect, Social Security, brokerage dividends, part-time wages. The difference is your zero tax conversion ceiling. If you want to push into the 10% bracket, add another $12,400 single or $24,800 joint. That's the top of the 10% bracket. You pay 10 cents on every extra dollar converted. Still cheaper than future RMDs. Step 2. Build a 5-year bridge in a taxable brokerage account before you retire. This part requires planning years in advance. You need approximately 5 years of living expenses sitting in a brokerage account. You should be able to draw it down without penalty or tax surprises. For Wesley, that meant $200,000 at $40,000 a year of expenses. If you can't do that, the ladder still works, but you'll need a backup. A 72T SEPP or part-time income to bridge years 1 through 4. Don't start the ladder hoping bridge money will appear. Plan it first. Step 3. Set up the conversion as a direct trustee-to-trustee transfer, never as a 60-day rollover. This part is mechanical but critical. The 60-day rollover triggers withholding requirements. It creates a window where one mistake means the entire conversion gets treated as a taxable distribution. A direct trustee-to-trustee transfer avoids that risk entirely. Fidelity to fidelity, Schwab to Schwab. One phone call, one form, done. That's the 5-year Roth ladder timeline. Grab the 1-page PDF in the description if you want a clean copy. Wesley executed all 3 steps. He converted $30,000 in 2026. He paid 0 federal tax. He started a 5-year clock. He did the same the next 4 years. By age 60, the first rung unlocked. By age 65, the entire ladder was paying him tax-free retirement money. Here's the part nobody told Wesley until after he did the math. Take the $150,000 he converted. Invest it in a basic index fund averaging 7%. It doubles in roughly 10 years. By age 70, that ladder is worth around $300,000. Every dollar of growth is tax-free for life. The federal government will never see another cent of that money. Not at withdrawal, not at his death when his heirs inherit it. The tax door closed on the day he hit the standard deduction. That's the move. One sentence to remember. The IRS publishes a number every year, the standard deduction. That number is your free conversion room. Use it. The 5-year Roth ladder timeline does 3 things at once. It bridges the 401k lockup before 59.5. It converts your future tax bill into 0. And it builds a tax-free retirement bucket that grows forever. If this hit, drop a comment. Which trap surprised you most? The Pro-Rata, the ACA cliff, or the IRMAA? And here's the watch next. If you like this strategy, you'll want to see what we did with the Save Plan Funeral. Same logic. The IRS publishes the rules, you just have to read them. That one applies to 7.5 million federal student loan borrowers facing a July 1st deadline this year. Most don't even know which path they're being defaulted into. The decision is bigger than they think. The timing matters more than the headlines say. Click that one next. I'll link it right here. That's the move. Money made simple.